Morning, everybody. It's Sunday morning. It's a beautiful day here in Kansas City. We just had our first freeze, though, so it's kind of nice because it'll send all the bugs scurrying back to their hidey holes for another 6 months, hopefully. Uh, it's been unseasonably warm, so they've been gnawing at me for a while. My voice is a little off. Yesterday was the opener for the Kansas City Roller Warriors, and I'm one of the announcers. So my voice is a little jacked up, and I'm super tired, which is why you're getting my living room instead of the normal half naked painting of the gentleman behind me. But you do get Baby Yoda, so that's kind of fun. Um, I did a poll on my socials to decide what to talk about today, and the lead vote getter was for me to talk about how I paid off my student loans early. And so that's what we're going to talk about. Real quick disclaimer, I'm not a financial advisor. This is really just me telling my story of how I did it. There may be some good lessons in there for you guys. But as far as investing goes, it's important to note that past performance isn't indicative of future performance when it comes to investments. There may be some patterns you can look at that can help you make more educated decisions and guide your strategy. But again, I'm not a financial advisor. I'm just here to tell my story.
Well, that's fantastic. A really smart decision, young man. We can put that check in a money market mutual fund. Then we'll reinvest the earnings into foreign currency accounts with compounding interest, and it's gone.
And for me, that story is really about the market crash in 2020. I had always been in the habit of investing more after a crash, just when the stock prices are nice and low and you can get a lot more shares for the money you're putting in. It's kind of like the day after Halloween when candy is, it's at a 90% discount. It's still candy, it's still delicious, but it's at 90% off, and so you buy more. Buying after a crash is kind of like that. You get more bang for your buck if you can sit and hold on to those shares for a year or two, or for the long term. You generally see you're generally going to see some good benefits from investing in that way. And I found something in the aftermath, well, leading up to the market crash in March of 2020, that to me seemed like a good investment opportunity. I had read about the travel industry being one of the biggest, if not the biggest, consumers of oil on the planet. And in 2008, the travel industry had a downturn which affected oil pretty significantly. And as the travel industry started to shut down in March of 2020, stock prices for oil fell tremendously. And looking at a bunch of them, the one I targeted was called Permian Resources. It went by a different name back then, but it's changed to Permian Resources since. The ticker is PR. It had a high prior to March 2020 in the $2 range. It dropped to about 30 cents. I bought in. I took a loan out of my Roth IRA for 4%, around $2,500, and I bought. The shares I bought were in the range of 50 cents to 75 cents. And it was a lot. It was, for me at the time, it was a big risk. With the way Roth loans work, you pay it out of your paycheck, and so I was basically giving up a portion of my paycheck in the hopes of holding it long enough for these shares to appreciate once the market turned around. Another fun fact: there was actually a market decrease in pollution after the 2008 crash and the 2020 crashes. Unfortunately, only temporary, but serves to kind of demonstrate the wider point. Now, fast forward a couple of years, 2022, that those 50 and 75 cent shares that I bought appreciated to between $12 and $13. The reason I pulled the trigger and sold a big share of my stake there was that I wanted to get rid of my student loans, because the way they're structured, they're just so predatory. I was really sick of watching 80% 85% of my payment go towards interest instead of the principal. And they're just structured in a way to keep you permanently in debt. And so I was really eager to get rid of those. Also wanted to get a home, buy a condo, because I'd noticed Airbnb was starting to buy up my block, and I was worried about getting priced out of my neighborhood, which is definitely not fun. A lot of people have experienced that, and I didn't want to be in that position. And so the appreciation on those shares did make it possible for me to bulk pay off my student loans and put a down payment on a home.
Finally, Big Earn is above the law. It's a great feeling.
Important to note, though, if you do attempt something like that, you got to make sure to set aside some of your profits for taxes, because the tax man does take a hit. After a year, when you qualify for long-term capital gains, it is a lesser hit, which is partly why the billionaire class loves to eat up real estate and shares and investments after a crash has occurred. And if I had to guess, I'm sure they're planning extensively for the AI bubble to crash at some point in the near future. And the takeaways from all this is that first and foremost, it's all risky. Like I mentioned, I wasn't making as much money at the time, and it was a risk for me to have a lower monthly budget and take a risk on these shares I bought appreciating into something that could make my life better. I was fortunate that it did, and my research was correct. But a lot of people have made smart decisions that, for reasons outside of their hands, just didn't work out. A lot of people tried day trading, which I would definitely not advise. That doesn't usually work out in the long term. You definitely want to, if you're going to invest in stock, you want to do so with the purpose of holding it long term, especially after a crash, because it can take many years for the market to recover, like it did during COVID. The second takeaway is that nobody can read the future. It's always good to educate yourself and read up on the investments that interest you. And you can try to discern patterns, like I mentioned, that can maybe help you strategize and guide your decisions. But no one has a crystal ball, unless you're on the signal chats going around in Washington or a billionaire. Chances are you don't have the gravitas to move markets. And so you're stuck trying to make the smartest decisions, and it's important to do the legwork to try to have that knowledge to guide the choices that you end up making with your money. Though if you don't want to try and pick winners, low fee index funds are a really good option. I have some investments in Vanguard just because their fees are the lowest, and those fees eat into your return over time.
And it's gone.
Anyway, I hope this has been giving you some food for thought and helped you maybe guide your decisions as far as your investing goes, and trying to make choices about the economic situation to come. And thank you for watching. If you have any thoughts on this story or anything you'd like to add in the comments, feel free to share. And if you just want to tell me I'm stupid, go for it. All I ask is that you hit the like button when you do it, just to give a little something back for mocking me. And if you're feeling up to it, feel free to please like and subscribe. Next time, I will put on the Ken costume I had for Halloween that I was planning today and let you know what that looks like. It was a lot of fun doing it, and it was a big hit at the KCRW opener last night. But I'm just too tired to do too much with this video today, other than just tell you my story. Anyway, I hope you all had a nice Halloween. We'll see you in the next video. Take care.
And it's gone.